All right, so the big news this week, guys, is the FOMC meeting. Now, we talked about this over the last couple of weeks. We're anticipating that the Fed is not going to hike this time. The market says about 50% chance. However, we've kind of gone through last week the 5 reasons why I don't think they're going to raise. Just as an example, CPI came in last month at 4.9%. It's projected to come in at 4.1% at the next reading, so this week. And that's a pretty sharp decline from last summer's peak. So at the peak last summer, inflation was 9.1%. So if we go from 9.1 down to 4.1 over a 12-month period, I'm pretty sure that our buddy Jerome Powell thinks that's pretty good improvement over the last 12 months. So that being said, I do think that in this meeting that he's not going to rule out another hike for July. So we'll see what happens. I mean, basically he's going to say that this is data dependent. And so depending on what the data looks like, what the data comes back with, he may or may not reserve the right to hike rates again. Now, that being said, there was some talk in the market. In fact, a large percentage of the market thought that there would be a rate cut this year by the Fed. That is not as popular as it was a few weeks ago. So it's looking like basically our forecasts were always that we would see some, Fed dropping rates maybe Q1 of 2024. That is still my thinking, and it seems that the market's jumping on board with that as well right now. So I would say the majority don't think there will be a rate decrease this year. So let's hold steady. Now, treasuries have kind of held steady at that higher level. So let's see what happens at the Fed meeting this week. I do think that treasuries are going to walk back down a bit after the Fed meeting. And of course, if inflation is going down, that can be some good news for us in the markets. But we are definitely already in a recession, and we are anticipating that treasuries will start scaling down again soon. How much, we don't know. As I have said in the past, it's just a roller coaster ride. So we're along for it, whether you like it or not. So that being said, I don't know if you guys read the news, but basically one of the largest malls in San Francisco failed. Basically, the bank or the lender took it back. I believe there was $160 million worth of debt on it. In fact, one of my private lenders was involved in that financing for a previous company she was at. So she was unavailable to us yesterday because she was getting looped in to start working on that project. So this is, of course, like the looming concern for a lot of banks, and why a lot of banks will continue to be conservative is basically all of this CRE debt that's coming due. They're planning on it starting to hit in 2024. So we could see lenders being more conservative. Now, some of our lenders that are multifamily lenders only might say, hey guys, we're healthy. We're available to do business because we didn't have all those crazy CRE loans on our books. But some of our other lenders that finance not only multifamily, but also commercial properties, they might be having some issues to work out. So I do anticipate that the lending market is going to be a little bit tight going forward for the short term and foreseeable future. But that said, we are still getting deals done, guys. We're closing on a land deal this week. Yes, believe it or not, we're closing on a land deal with a lender. That particular client could not get anything done elsewhere. He had been looking. We ended up getting the deal done for him. We were doing second trust deeds against properties. We are pulling cash out of other properties. So if you're a pretty straightforward borrower or not, it's worth checking in because there are still options, right? So San Diego is a pretty healthy area in terms of real estate values and things like that. So we do have the benefit of still having a good pool of lenders that we can draw from. There's less than we had before, but we definitely still have a lot of great competitive financing for the market given the times available. So if you are looking into it and kind of looking at your options, continue to check in. I would say every few weeks if you don't feel like you're ready just yet, but at least do check in because things are changing and they're changing often. So have a fabulous week, you guys. Thank you so much for listening. If you have any questions, feel free to reach out. You know where to find me.